Hello investors, welcome to Simpli Stocks. Moving forward with our March quarter Q4 FY26 result series, today I have brought 4 very special and trending businesses for you. We will be doing result and con call analysis of Manorama, Allied Blenders, Vintage and PN Gadgil today. So without any delay, let's quickly get started. The first business that we will cover today is Manorama Industries. Manorama has been a portfolio stock of mine for quite some time now, and I have been covering it in our Simply Stocks community and also on this channel for a long time. Still, if there are any new investors among the audience, I'll briefly explain Manorama's business model. So this is a proxy FMCG company that manufactures specialty fats and cocoa butter equivalent or CBE for confectionery, chocolate and cosmetics companies like Mondelez, Ferrero, Nestle, L'Oreal and The Body Shop also. These products are used as replacement for cocoa and other fats in chocolates, food and cosmetic products. As you would know, pure cocoa is quite expensive. So FMCG companies get a cost advantage by using CBE. Manorama manufactures these specialty fats from mango, shea and sal seeds which are sourced from the forests of India and Africa. Now let us come straight to their Q4 or March quarter results. So you will see that in Q4, Manorama's sales have grown by a massive 64% over last year to 382 crore rupees and EBITDA has increased by 61% to 103 CR. These are very good numbers, I'll say. The market had slight concern that since Manorama is majorly an export business, perhaps rise in logistics costs and then also loss of business in the Middle East would impact their results. But management told in the con call that they have very low exposure in the Middle East, so there was no impact from the war. A little bit, yes, risk is there related to freight costs, that will remain, but that is common, I'll say, for all businesses. Lastly, you will see that net profit growth was slightly lower at 41%. And the reason for this is that the rupee was quite volatile during Q4. So to manage currency risk, the company made a mark-to-market provision of around 17 crore rupees in Forex. Now going forward from here, they will follow a 60-40 ratio in which they will remain 60% hedged while the remaining 40% share will remain unhedged so that they can also get some benefit from currency fluctuations. The EBITDA margin came in at 27% in both Q4 as well as for the full year FY26. The management says that for now they will remain in this 25 to 27% EBITDA range this year or FY27. But yes, in the long term, forward integration and the addition of value-added products that will support margins. Like if I give you an example, previously the contribution of CBE in sales was only around 10% or so, which has now increased to nearly 30%. So this has brought the margin expansion. Similarly, in the future, as more and more value-added products come, it will help the company to increase the margins as well as the realizations, or let us say the sale price of their products. Although there is one thing, if you look here, you will see a drop in the gross margin. And the reason behind this is that while their main plant is located in Raipur, Chhattisgarh, the company has operationalized 9 different subsidiaries across Africa, UAE and Brazil for various purposes in one single year in FY26. Now, since everything was being set up there, so it impacted the gross margin. However, that I will say is not a major issue. The management had already given us a broad, let's say, gross margin guidance range of 40 to 50%. So this is within the band. Now let us come to Manorama's capex and expansion plans. So through debottlenecking, or let us say by making minor changes and improving processes in their plant, they have increased the capacity of their second fractionation plant from 25,000 TPA or tons per annum to 32,500 TPA. Similarly, a debottlenecking exercise will also be carried out for the first plant in FY27. Their capacity utilization is currently around 85%. So there is definitely scope to increase production, and this debottlenecking exercise will increase capacity a bit more. But you know what is the biggest benefit of this debottlenecking exercise? So capacity can be increased slightly without incurring any, let's say, very heavy investment or capex. Plus, they will also be increasing the rates of their products by 5 to 10%. So overall, the company has a very good, let's say, scope or I will say we have very good visibility that company can keep growing its sales this year in FY27 as well as next year in FY28 too. Now, the management has not given obviously any guidance for this year at the moment, but given the way growth levers are, I think we can expect at least 25 to 30% growth. And after that, they are investing approximately 460 crore rupees for future growth. In this, they are setting up a cocoa butter alternatives plant and a third solvent fractionation plant and also a refinery capacity of 90,000 metric tons per annum. The capacity of the SF3 plant will be 75,000 tons. These projects will help Manorama to introduce high value products where margins can be even better. So these are their growth plans that will keep Manorama in focus going forward as well. They have also planned a slightly large 120 crore rupees capex in Burkina Faso of Africa. As of now, they import raw seeds from Africa, but in the future, what they will do, they will do their basic processing right there and then they will ship them directly to India in butter form. So this is also a major trigger, because what happens is that these seeds or raw materials make up about 45 to 60% of the cost. So firstly, logistics cost will decrease. And secondly, since the seeds will be processed immediately, they will yield more fat. Like seeds arrive in India a bit late. So by that time, efficiency drops. So this backward integration will also help with the margins. So at a PE of 37, 38, you are getting a fast growing FMCG, or you can say proxy FMCG business, which you can study on your own. Manorama operates on a cost plus business model, which further makes it a moated business model. Cost plus means that in a way, Manorama has told its customers that so and so is our cost structure and we will sell to you by adding 40-50% gross margin on top of it. So customer stickiness is also high here. Customer trust is there, and this model keeps competitors away as well. Apart from that, asset turns are also very good in this business. So it is a good business with a high return ratios. So I think you should take a look at it once. After Manorama, let us quickly go through the alcohol business, Allied Blenders and Distillers, or ABD. So Officer's Choice and Sterling Reserve are two famous whiskey brands of Allied. Apart from this, their iconic whiskey has also been quite a hit, which has brought good growth for them. Now, walking in Radico's footsteps, what Allied has done, Allied has also launched several new products in its prestige and above, meaning super premium to luxury alcohols portfolio. There are many new launches like Russian Standard Vodka, Zoya Gin and Woodburn's whiskey, which are doing well right now. And recently, they have also brought Amar Sinha to MD position. Amar Sinha was previously the Chief Operating Officer at Radico. So this management change is also a positive development. So ABD's business is now gradually shifting from the mass market to premium and luxury alcohols. And luxury or expensive alcohols have margins of up to 40%. So as the proportion of expensive alcohols or alcohol goes up, the margin expansion will happen. In such a scenario, profit growth will be even better. And you will see the company's P&A or prestige and above portfolio has done quite well along these lines in Q4 as well. P&A volumes grew by 20.5% year on year, and now nearly 58% of the contribution to overall sales comes from this segment. Sales wise, 24% growth was recorded in the luxury portfolio. So these are very good numbers, I will say, because see, alcohol is not exactly your very high growth sector. So even this much growth is very healthy here. However, in the mass premium segment, you will see there is decline of 2.8%. But on a quarter-on-quarter basis, there is recovery of 5.6%. Their mass premium segment, or let us say regular alcohol business, was affected due to changes in the southern states. Like Telangana itself, which is their main market, it has seen change in licensing fees. Apart from this, their flagship brand, Officer's Choice, has also degrew a bit in the last few quarters. We are seeing, although recovery now, they are putting efforts to stop the degrowth in Officer's Choice business. The management says that from here, mass premium volumes can grow at a rate of 5 to 6%. So it will recover back. The main focus will obviously remain on the P&A portfolio, where the management has given a guidance of or growth guidance of 17 to 18%. Now, before we move forward, you will notice that one thing here, that due to zero growth in the mass premium segment, the company's overall sales growth was just 11.1%. Whereas the main trigger, the luxury portfolio, performed well. This means the low margin business in Allied is hiding the true numbers or the true potential. So if you look at it superficially, you won't see any extraordinary growth in sales, but profit growth is still there, right? Because your high margin segment that is doing well, and this is exactly what you will see in their results too. Sales grew by 9% overall to 1020 crore rupees, but your EBITDA grew at a faster rate of 21%. The EBITDA margin has also expanded from 16.1% to 17.9%. And this very EBITDA margin expansion is the trigger in Allied for which we are tracking this business. Like, this improvement is of almost 2 percentage points. So this is a very good performance. Margins have improved due to the increasing contribution of premium products and also the backward integration projects which they have executed recently. However, the net profit has dropped by 52% year on year to just 38 crore rupees. But you must understand that this is not due to any operational or business weakness. The company is currently undergoing capex. So depreciation and capex related interest costs have increased. A little pressure was also seen on PAT due to tax adjustments, but the core operating performance has been perfectly fine. And in the coming quarters, the results will normalize. And since the mass premium portfolio is also stabilizing so slowly, so the top line growth that is not right there right now, so that will also return. So with all this, let us quickly look at the growth and capex plans of ABD now. So ABD is undertaking a capex of 525 crore rupees to increase its manufacturing capacity for ENA, malt and PET bottles. With this capacity coming online, their margins will become even better. Some of their capacities went live this year and more will follow ahead, like the PET bottle manufacturing plant in Telangana became operational in Q2 and it even turned EBITDA positive in Q3 of FY26. However, their margins in FY27 will remain similar to FY26. We will not see margin expansion this year like we saw in FY26. And the reason behind this is that the benefit that was supposed to come from backward integration onto margin expansion got set off by some disruptions caused by the war. Like, you would know that due to gas shortage, glass bottles have become expensive. Similarly, logistics costs have also increased. So sales growth is still strong in this business, but it is just that the margin expansion we were supposed to see in FY27 has now been delayed to next year because of the war. Therefore, the positive impact of benefits like backward integration and free trade agreement will start flowing from FY28 now. Now, as for the rest of the capex plans, the update is that the malt plant will start in H1 of FY27. Then 2 bottling units will be added in Uttar Pradesh and Maharashtra in H2 of this year, FY27. And I already mentioned that the PET bottle plant has already started. The ENA distillery capacity will be added next year in FY28. All of this backward integration will help ABD to reduce its costs. These are raw materials for the company and currently they source them from the outside. These phase 1 and phase 2 backward integration capex projects will bring an improvement of around 300 basis points in EBITDA margin by FY28 and an additional benefit of 100 basis points in FY29. So even with the sales guidance of just mid-teens growth or around 15 to 16%, this margin expansion can easily drive a very strong bottom line growth of at least 25, 30 or 35% in Allied. So this is a very good business. I think that should be on your radar. As for the future growth, they are focusing on channels like CSD or let's say defense canteens, international markets and also travel retail areas like airports, etc. So Allied Blenders is a good fast growing business. The PE will seem high to you, but you must understand that alcohol is a highly regulated sector. That is why all businesses in this sector trade at expensive valuations. So there is regulatory moat sort of. In Allied, there are triggers for bottom line growth here and along with scope, I'll say sufficient scope for PE re-rating. The mass market portfolio is impacted, which is hiding the company's true potential. Because of that, plus because of the concerns around gas shortage, ABD has corrected, but you see the premium portfolio is still doing quite well and the margins here are so strong that they can easily absorb any cost pressures because of the war. So I will say it is a good business you can track. Now, humble request, just before moving forward, if you are liking this video so far, please give me a thumbs up. Also, you can subscribe to our channel Simpli Stocks, where we bring multiple such videos every week. I know I keep saying this again and again, but you don't do that. But you see, honestly, your likes and subscribes are our only motivation so that we keep bringing such high quality research to you for free. So do like this video, and yes, also support us by subscribing to our channel. Anyway, let us get back to our businesses. So the third business we are going to study is Vintage Coffee and Beverages. Vintage is a B2B coffee manufacturer, as they make coffee for other brands or companies. They are mainly export focused, like only 5% of their sales come from India. Africa has 31% share, Russia and CIS account for 22%, Southeast Asia has 22% again, and the Americas and Europe account for 18%. Their exposure to the Middle East is very low, so the war has not impacted this export business. Yes, whatever shipping or freight costs that have increased, they are passing those on to their customers. Now, let us get straight to their results. So, in Q4, company sales grew by 57% year on year, and there is 68% growth in EBITDA. As EBITDA growth is higher than sales growth, this means they have benefited from operating leverage. However, the net profit growth has came in lower. This is due to tax adjustments, like it is not written here, but the profit before tax grew by 64% in line with the EBITDA. So overall, these are quite good numbers. Moving forward, the company recently increased its spray-dried coffee manufacturing capacity from 6,500 metric tons to 11,000 metric tons. And the management says that in FY27, they will be running this at 95% or around full capacity utilization. So this new plant will bring good earnings growth this year in FY27. After this, the next big trigger for them is the freeze-dried coffee project. Freeze-dried coffee falls into the premium category, where both margins and realizations are much better compared to normal spray-dried coffee. Vintage coffee's 5,500 metric tons of FDC capacity will come next year in FY28. After operationalizing that, they will be bringing even more FDC capacity in the future, but those are somewhat long-term plans. But anyways, the upcoming phase 1 of FDC expansion is sufficiently big enough trigger for this business. For now, their entire focus is on running this 11,000 metric tons capacity at full utilization in FY27 this year, and also making sure that 5,500 tons of FDC line comes next year on time from Q2 of FY28, and it will be online for 9 months, and they will be running it at roughly 70% capacity utilization for those 9 months. So the company has a very clear roadmap for the next 2 years, and this is something I really like about Vintage, that their execution is rock solid. Along with this, they are also slowly and steadily increasing their focus on premiumization. For instance, in their business, the share of agglomerated coffee and small consumer packs, that is increasing, and in the future, sales from FDC will also start coming in. So this will help to improve realizations, or let us say the sale price of their product, and also the EBITDA per kg, or the margins going forward. So these 2-3 things will help to improve the margins and realizations. Right now, their EBITDA margin is around 18.5%, and they are guiding for an EBITDA margin of around 19% in FY27, and then up to 20% next year, FY28. Now, I know this is a lot of data for you. So based on this, let us calculate the valuation of Vintage. In FY26, you will see that their sales grew by 79% compared to the previous year. EBITDA grew by 88%, and PAT also increased by 80%. Their EBITDA margin last year was 18.5%, and PAT margin was 13%. And as I told you, in FY27, their production will increase by 55% to reach 11,000 metric tons. And by FY28, it will increase by another 26% to become 13,900 tons. This is what the management has said regarding the FDC capacity coming online. Apart from this, they have given an EBITDA margin guidance of 19% for FY27 and 20% for FY28. So on the basis of this, they can do around 880 crore of sales in FY27, and at a 19% margin, estimated EBITDA comes out to 167 CR and 119 CR that comes out. This is for FY27. Along the same lines now, for FY28, on sales of 1200 crore approx, they can manage to do an EBITDA of approximately 240 crore rupees and a PAT of around 175 CR. So you will see that right now after FY26 results, full financial year results, based on that, this business is at a PE of 29, but on estimated profits of FY27, its 1 year forward PE comes out to 18, and on the FY28 figures, the 2 year forward PE comes out to just 12, which is a very attractive valuation for this business. So looking at the overall picture, Vintage Coffee is a very interesting FMCG business. It is in a good expansion and premiumization phase. Right now, good top line growth is coming into the business, and then moving forward, margin expansion will drive that growth. So this is a good business that you should look at. Now, finally, the fourth and final business that we will cover is Gadgil Jewellers. This business has trended the most recently, though that is a different matter that it has trended for the wrong reasons. So you would all know that PNG is a jewelry retailer like Kalyan and Tanishq. PNG has been mainly Maharashtra focused so far, and now finally they are expanding into Madhya Pradesh, Uttar Pradesh, Gurgaon, Jharkhand, etc. They now have a total of 78 stores across 36 cities. They have managed to meet their store expansion and also sales growth guidance for FY26. No problem over there. However, there were some stress points in their results and then also in the con call. Now, this video is getting a bit long, I know. Thank you for staying with me so far. So let us get straight to the negative points, because discussing them, that is more important. So here you will see that in Q4, the company's sales grew by 123% compared to the last year, and they have crossed 3,500 crore rupees mark. Retail sales have increased by 103%. And if we look at the full FY26 performance, the company delivered 40% sales growth compared to the previous year. But the problem has been in their margins, and this is the reason why the market has reacted so negatively. Although the gross profit increased by, you will see here, by 80% over last year, but you will also notice that gross margin has dropped from 12% down to 9.7%. And due to this margin contraction, the net profit growth came in much lower than sales growth at 46%. Now, if you look at it on standalone basis, then yes, these results are good, no problem. But you have to understand that market looks at things comparatively. The results of other jewelry players have been better than PNG. Now, the management told in the con call that margins were under pressure due to an increase in the contribution of gold coins and bars in Q4. Like, the contribution of gold bars and coins went up to 40% of the total sales. And to some degree, this also happened with Kalyan and Titan as well across the sector in Q3 and Q4. We saw higher investment demand for gold due to rising rates, and margins are obviously low there. Like, there are not really any significant making charges on gold bars and coins, right? So margins are lower for jewelers. But Kalyan or Titan did not see that heavy contraction in margins as Gadgil. So that is troubling. Along with this, they mentioned, I mean, management of PN Gadgil, they mentioned that they ran Foundation Day and Gratitude Day campaigns, during which they gave discounts and promotional offers on making charges. This campaign was to mark the milestone of 75 stores. Because of that, the contribution of studded jewelry, which is a high margin product, was lower. Customers moved to plain gold jewelry. Then management also excused that as they are growing, so they spent more on marketing. But see, the problem over here is that they are growing anyways, right? The company is growing all the time. So almost all of their new stores will be outside their core geography of Maharashtra. So in that way, they will have to spend more and more on marketing, on brand creation or promotion. So that is one thing. Plus, another thing was they highlighted that because of festivities like Gudi Padwa, they gave further discount or they ran promotions. But then same thing, Gudi Padwa or festivities will come every year, or promotions will keep happening constantly. So it is not one time, right? And another reason management gave was that many of their franchisee stores have come up in Q4. Margins are lower in those. So there also the same counter argument applies. They are going to focus on opening more and more franchisee stores going forward anyway. So it is difficult to assume that margins can remain strong going forward. So that is why the market is not gaining that much confidence in Gadgil. I feel the management did discounting to meet their targets and push the sale of gold bars and coins to show the top line growth. And this is not the first time, because multiple times I have seen inconsistency in Gadgil's management. After the IPO, that there was that B2B bullion sales situation that happened, which was very confusing for the market. Then in the Q3 con call, they cut their guidance so sharply. And now again, this gold bars and coins case is coming up. I am not saying that their numbers are bad or the management is not good. But when there are so many issues, I personally cannot bring enough confidence to give a large allocation to such a business. That trust just doesn't come from within. And you will also agree. In comparison, for example, I am very, very happy with the management of Sky Gold. But anyways, their operational metrics have all remained strong, no problem over there. Let us move forward. But you will see that those have come out very well for all the players in the industry. So let us not go too deep into that. Now for FY27, let us see. So the management has given a sales guidance of approximately 13,500 crore rupees. Along with that, their target will be to maintain EBITDA margins in the range of 7 to 7.5%, and the PAT margin will be around 4%. Now, after the correction, the P definitely has become very low. It is just 18. So valuation wise, everything does look good. But again, I will say that Kalyan has also corrected. You can go and see. So if you want to play with a small allocation, then you can sure go ahead and look at Gadgil. But I would say that from the point of view of a quality business, from the point of view of a putting heavy allocation in any business, I personally right now I am not able to bring that much trust in Gadgil. And because the problem is that since so much has happened, the market sentiment may remain weak for this stock going forward for a long time, or let us say for at least some time now. So that is something you will have to, let's say you will have to keep in mind, that you do not just look at the PE, you also look at other things, the inconsistency in management, the let's say sentiment around the stock, all those things. Now, at the end, if you found this video interesting, then please give me a thumbs up, and you can also subscribe to our channel Simpli Stocks. Through Simpli Stocks, our purpose is to simplify such unique hidden business models for retail investors and then bring them to you, so that the same research that mutual funds and ACE investors have, that is accessible to you as well. So if you support us by liking this video and subscribing to our channel, I'll be able to bring more such videos for you. So I'll see you in the next video with this. Happy investing.